evening. Thank you very much for joining us here on Urban Debate on Mirror Now. I am Heena Gambhir. You know, at one time, roti, kapda and makan were considered the basics millions used to dream about and toil endlessly for. Today, there is food guarantee. There are home for all government schemes for economically weaker section of the society. For the middle class and others, home is not a matter of aspiration, but essential. And for millions, a home depends on a three-lettered abbreviation. If it's high, a million dreams die. If it goes down, a million hopes soar. So that magic word really is EMI. And what do you do when the constant increase in prices of commodities is creating collateral damage? Makes a self-owned home a mission impossible. Even before the dust could settle on the impact of pandemic on our economy and our lives, we are hit by another global event, the Ukraine-Russia war. It has set fire to the prices of fuel, natural gas, coal, nickel, copper, aluminium, titanium, and palladium. This high commodity cost will have a direct impact on manufacturing and infrastructure sectors, which are key contributors to job and growth. Now, this is just one part of the story. The hole in your pocket is set to get bigger. Banks are increasing the lending rates. 5 banks so far have done that. The latest one is HDFC. It has raised the lending rate by 5 basis points. Lending rate is the interest charged by a financial institution for giving you a loan. Now, this, viewers, means that EMIs of existing borrowers and prospective buyers is set to go up. And this will have a ripple effect on your monthly budget. Calculations and experts say this is only the beginning. So what more should the EMI pairs be prepared for? We'll try and decode that for you on Urban Debate on Mirror Now this evening. Joining us is Subhash Chandra Garg, former Finance Secretary of India, Dr. Brinda Jagirdar, Independent Director and Senior Business Economist and former Chief Economist SBI, Dr. Sunil Sinha, Director and Principal Economist, India Ratings, live with us. Mukesh Pandey, founder, Rupya Paisa, who's a former banker, also joining us. Trishul Shetty, CEO, Raheja Engineering, also on the broadcast this evening. Good evening to all of you. Thank you for joining us here on Urban Debate on Mirror Now this evening. Let me begin the discussion with you, Mr. Subhash Chandra Garg. This is just the beginning. It began with SBI and a few other banks. Now, HDFC has also increased the retail lending rate. Simply put, the EMIs are going to go up. What can the EMI pairs expect in the near future, given the current circumstances?
Heena, the people need to buy houses for their living. You rightly said this is one of the most essential items of their living. Whenever somebody wants to buy a house, it needs to pay the cost of the house, which is going up also thanks to considerable increase in all kinds of materials which goes into the house making, whether it's steel, cement, wood, or bricks, or you name anything. So all these things are going up. So the house owner or the house aspirant need to pay much higher cost for getting the house. Now, no one, or barring very few, have adequate money to buy or the savings from them to buy the house and put in the entire thing as equity. So they take loans. Now, the loans come from the banks and the non-bank finance companies. The banks also have their own costs of funds, and they also have the demand for the loans. Now, what we are seeing is that the demand for the loans is going up, and the deposits in the banking system are coming down relatively. The growth is much smaller in deposits now, whereas the demand for loans is much higher. And in such a situation, the banks need to cover their cost, as well as some will take the opportunity to make a little bit of more profit by increasing their net interest margins. But what we have seen so far is that the banks have not really gone in for taking the advantage of the situation and raise the EMIs or the interest on the loans which they gave to the householders disproportionately to the cost of their deposits and funds. So I think what has commenced right now is the beginning, and as things stand in times to come, perhaps the rates of interest which the banks charge and the EMIs will go up further.
EMIs will go up further, so that's in a way not a very good news for people who are looking to take loan, who are already paying EMIs. Dr. Brinda Jagirdar, what can EMI payers really expect? You just heard what Mr. Garg had to say. What is your assessment of the current situation? Because most economists are expecting that during the next policy review meeting, for sure the Reserve Bank of India is going to increase interest rates.
Yes, absolutely. It would change its policy stance from accommodative to neutral, and then it would increase the interest rate. But Heena, before that, now this increase in interest rate that we are talking about, this is the effect. But what is the cause? One is inflation. Inflation of food and non-food items, they have gone up, and oil prices have led to this increase across the board, not just in India, but globally. So inflation in the US, for example, is touching more than 8%, and in India it has crossed the RBI threshold of 6%, but RBI is willing to wait for another 1 month at least to see how it comes, and RBI believes that it would come down later. But right now, inflation is the biggest concern, and at the same time, growth is also low, so this is a dilemma, but inflation is a bigger issue. Along with that, RBI is also unwinding liquidity. Now, when you drop out liquidity, what happens is that the near-term interest rates go up faster than the long-term rates. So the yield curve becomes almost flat. So that is what we are seeing now. The near-term rates have gone up sharply. Now, all this is reflecting in an increase in the rates which banks have to charge their customers, and EMI is one of them. Now, it is affecting not just one section. Now, for the individuals, yes, but even for the government is paying. Government will have to, if interest rates go up, then government borrowing cost will also go up. In turn, it will push up the fiscal deficit. In turn, it will make Reserve Bank Reserve Bank even more difficult to have an easy money policy. So the rates were continuously going to go up. When the rates go up, then everyone is affected, impacted, not just the middle class. And today the situation is globally. So let's not talk about only one class saying that class is being affected. I think every single person, in fact, when oil prices go up, then inflation across the board, the whole, all input prices go up, vegetables, fruits, transportation, logistics, all that goes up, and everyone is hit. So I think today we are in a situation which is really very difficult, and it would not be fair to say that the middle class is bearing the brunt. I think everybody is bearing the brunt, and till they decide that the Ukraine-Russian war situation gets resolved, one way or the other, and quickly, it should get resolved quickly, and I think they should end the war fast. Because, as you rightly said, the world is just now coming out of the corona crisis, and now we are faced with another crisis. So it's very difficult to bear the impact of this brunt.
Okay, so Dr. Brinda is telling us that rates will continue to go up. Everybody is bearing the brunt. No one, in fact, has been left as far as the impact of this rate hike is concerned by the banks, the lending rate specifically by some banks. But Dr. Sunil Sinha, do we have any sort of an analysis as to how much of rate hike can be expected, the lending rate specifically, say, in this particular calendar year?
It's very difficult to say because much would depend upon how the Ukraine-Russia war, drags on or when it comes to an end, because ultimately that's what is going to determine the global commodity prices. And in fact, if one really looks at the inflation and inflationary expectation, then a large part of it is obviously driven by the global development. I mean, in a way, it's an imported inflation. But nevertheless, the situation as of now is that clearly the inflation is above the tolerance level of RBI. So certainly, this is something which is at the back of RBI's mind, and RBI in the recent monetary policy has also revised its inflation, average inflation for the fiscal year 23, which now stands at 5.7% average. But in the near term, the likelihood is that it will remain in excess of 6%. So in such kind of a situation, it becomes extremely difficult to continue with the accommodative policy stance which RBI has been continuing. And many people believe that RBI is already behind the curve, I mean, in terms of containing the inflationary expectation, which then spirals. Once it spirals out, then it actually feeds into a lot many other sector, people's expectation across the board. The wage increase becomes inevitable, and so on and so forth. So it is important for RBI to really look at these issues, even though the growth remains one of the major concern for RBI, but under the current macro condition, it will be very, very difficult to remain accommodative. So our expectation is that in the June policy review, the repo rate most likely will be increased by 25 basis point, and thereafter also much would depend upon the kind of data that will be coming in. But given the way things stand as of now, we expect that there could be another 25 basis point increase. So altogether, our expectation is that given the macroeconomic conditions that are prevailing currently or expected to prevail over the next couple of months, might actually lead RBI to go for altogether about a 50 basis point increase in repo rate during the current calendar year.
Okay, so you're expecting an increase of about 50 basis points as far as the repo rate is concerned during the current calendar year. Mr. Mukesh Pandey, if we do see this kind of an increase, what does it really mean for people who already have a home loan or any other kind of loan, or who are looking to buy? Won't it then discourage them, or won't it then make them rethink about their plan? Because we also have a problem of mehengai, inflation, which is already burning a large hole into our pockets because of many other issues. Our vegetables are expensive, fuel is expensive, eating out is expensive, cooking gas is expensive. Now even the EMIs are going to go up.
Exactly. India is not going through very good phase. From last 3 years after COVID, India is recovering. And the increase in rate of interest will certainly impact all the businesses, since last 3 years raw material prices is on all-time high. And this increase in rate of interest and will certainly impact the growth of every business owner. And yes, as the panelists are saying, there is a possibility of increase in rate of interest by 0.25 basis or 0.45 basis point. Then that will certainly increase the EMI burden on the business owner, which will ultimately impact the growth of the businesses.
Sushil Shetty, would it then not impact the real estate sector as well, which was also, seeing a bit of recovery after the Omicron-led third wave and 2 years of pandemic that we were all into?
Yeah, hello everyone. See, over the past few years, because of COVID, real estate was really impacted. We had seen a very bad phase. Now things were improving. Again, there is this war going on. Now, because of this war, most of the raw materials, the price has increased. Now, at the same time, we are seeing there's a hike in inflation. Now, the RBI has come with a few new policies. Banks have increased their interest rates. Now, we have been, the problem is becoming more of a holistic type of problem where we've been facing all the sides. The raw material is increasing, so we are supposed to know what is the, we need to correct this problem, so we need to hike our rates. At the same time, this bank has increased their interest rates. Now the demand might reduce. Now we need to watch. But as we've seen previously also, the demand, there is an impact on the demand. Now what we would request is, there has to be kind of a balanced policy where, maybe in case if it's for a short time, the inflation, and because of, if RBI is, the planning is to reduce the inflation. If it's a short term, we are with the government. It's okay, we can handle it. But over a long period of time, keeping the increased material rates and again with the inflation, we are heading towards a, not a very favorable phase. Yes.
Okay. Of course, the signs are not looking very good. Mr. Subhash Chandra Garg, what is your view? How much of increase in rate are you looking forward to in this calendar year? Because like Dr. Sunil Sinha mentioned earlier, that RBI is already behind the curve. Do you also expect an increase of about 50 basis points by Reserve Bank of India? And what would, if that happens, what would that mean for people who are paying EMIs?
So, see, the RBI pegs the rates now to the retail inflation, the consumer price index. And if you look at the behavior of the consumer price index and the wholesale price index, for last quite some time, the consumer price index has been much lower than the wholesale price index. Wholesale inflation is about 14-15%, whereas retail inflation is only about 5-6%. It has just crossed the 6% threshold. What the construction industry and the real estate industry faces is the inflation in the wholesale side, not the inflation on the retail side. So their costs go up when the commodities, steel, cement, and other things go up, and all the transportation cost because of the higher petrol and diesel prices go up. Fortunately for them, so far, the interest rates were lower because the RBI was pegging the interest rate to the retail side. Now that's changing, and as was pointed out also, that it is expected that the consumer price inflation now would go up. You have seen the basics, the consumer price index, because of the fact that it is linked to the much of the food prices, so to say. And the food prices were having a very low inflation thanks to overproduction of cereals and other kind of things. But now the war situation has changed that dynamics also. So the wheat prices have started going up, the edible oil prices have started going up very sharply, and the vegetables would also face. So if the consumer price index also go up, the RBI would have no option left except to increase the rates of interest. And both the construction industry and the real estate industry will face higher interest rates, and the consumers or the investors or the people who are buying the houses, as I said earlier, they will face the double whammy. The higher cost of the houses and also the higher cost of servicing the loans which they have. So I think the times are difficult. There is one element which we should not forget that might be the option for some of them, and that might have implications for the demand for the real estate industry going forward. We still have oversupply of the houses in the system. Then the demand for the renting of the houses are concerned, and therefore rents have not seen the rise so far as much. So many households might decide not to go for a fresh or new house, rather go for renting. It might that the rents may also go up if the demand goes up. But for the time being, faced with a situation of very high cost of construction and higher interest rate, and the incomes not going up that fast because wage revisions are not that much. So my sense is that the householders would have either a very difficult choice to bear the higher cost of construct houses and the rate of interest, or go for postponing their purchases or reducing the size of the house which they buy, and or go for the renting of that. I think that's a very difficult choice, but that's going to be the case to my mind.
But then, as you said, times are difficult. So the choices, of course, are also going to get very, very difficult. You did not tell us how much of an increase in terms of rate are you expecting from the RBI, or you think will be right, at least in this calendar year?
So I think it's not much of a point in speculating that, because RBI has many other considerations to take care. RBI has to also see that the government's borrowing program is financed at a reasonable rate, and that's what makes RBI decide to postpone sometimes what the economy might demand in terms of rates of increase. In my judgment, it should have already been increased, the repo rates and all, but they've been postponing. So there are many others. So you can't second guess the RBI the way they would decide what plays more important role. But the economy is already having higher rate of interest. The government's borrowing cost, despite RBI not raising the repo rate and all, have already gone beyond 7% for the 10-year paper. So if you go by the fundamental factors, I think in next 3-4 quarters, rate of interest between 1 to 1.5% in repo would be probably justified. But RBI would have many other considerations to take into account, and how much they do increase is for the RBI to decide.
Okay. Dr. Brinda Jagirdar, what is your expectation? Because we were expecting the Reserve Bank of India to increase the interest rate in the last policy only, but that did not happen. Of course, an option was given to the banks, following which banks have started increasing their lending rates on their own.
I think the Reserve Bank has signaled very clearly that it is ready to, it has prepared the markets that now we will change our accommodative stance, bring it to neutral, and we will start raising the rates. Now, the thing is, RBI in its policy said that we are assuming that the oil prices would remain at about $100 per barrel. It has already crossed 100, it has gone to about 120 or so. So that is one factor which we need to consider. And second is also the monsoons. So we don't know how the monsoons are going to play out and what impact it is going to have on our agricultural production. And I understand that the severe heat wave is already affecting the wheat crop. So wheat crop is also expected to be a little lower than what it was last year. So in such a situation, it already, inflationary forces being built up, RBI will have very little room to do anything else except to raise the rates. And my own sense is that the RBI is going to not be as aggressive as the Fed. It will lag the Fed action, because we need to be aware of growth also. We can't stifle growth, so we want a situation where we can bring inflation under control, at the same time not hurt growth. So my own sense is that probably another, by the next year, let's say March 23, we'd see about 100 basis point increase in the interest rate, the repo rate. But there's one silver lining, I think. We are only talking about borrowers, but there's another huge constituency out there, the depositors, who have not been given, who have not been receiving their proper interest rates, proper returns. And I think now they will be a little happy, because they will have a little more cash in their hand.
Okay, and do you think that is also, a pressure that banks are already facing, because the interest rate of various small saving schemes were not changed the last time by the government, and on the other hand, the fixed deposit rates and other bank deposit rates have also been quite low. So that's another reason why banks are now going to be more aggressive in terms of increasing the deposit rates?
Yes, banks will have to increase deposit rates because if there's demand for credit which is going up, corporates have already shifted out of the markets and they've come back to the banks because market rates have gone up faster than the bank rates. So if demand for credit goes up, if manufacturing activity keeps up the tempo, then the demand for credit will go up, and to meet this, banks will have to garner more deposits, and they can do this only by paying higher rates. So I think the depositors will have some reason to smile, but yes, the borrowers will find the pain, and those who are,
Well, I don't know whether the consumers are smiling or not, but Mr. Garg is quite happy with this aspect that definitely, for depositors, there is going to be some good news. So there is definitely a silver lining, and we need to highlight that. Dr. Sunil Sinha, you were the first one on the show to, give us a number in terms of increase in rate that you are expecting from RBI. So if we see a 50 basis points increase in the interest rate by Reserve Bank of India, do you have any calculation to suggest how much this would translate into as increase in EMI for somebody, say, who has a home loan right now? How much of a difference can it really make? How much should a consumer be prepared to pay, say, by the end of the year if there's a 50 basis points hike?
Look, if you look at the housing lending rate, then just compare it with the rate at which banks are lending to the individual house borrowers and the rate at which Government of India borrowing from the market. The Government of India is borrowing from the market close to 7%, whereas the housing loans are still being, the floating rate is still around 6.5%. So this anomaly cannot go for a very, very long time. And this is what will get corrected eventually over a period of time. But how much time it will take is very difficult to say because, again, a lot of these things depend on the demand and supply of both creditors and depositors. And at the same time, one also has to see that, under these macro conditions, what exactly RBI will do. But as I said earlier, RBI is likely to increase the repo rate. And one of the advantages which banks had till now was that in the last 2 years when, we were facing COVID and related issues, a lot of, income of at least the middle class or the ones who still have their jobs intact was ultimately getting accumulated as savings. So there was a significant amount of increase in the CASA, which obviously was very favorable for the banks. And that's the reason why banks were able to hold on to the lending rates despite the fact that the rates in the capital markets have gone up. But now that things are changing whereby, the RBI will raise the rate of it, likely to raise the rate of interest. And also, if manufacturing activity, the way it is going, if that picks up and the credit demand goes up, both from the government as well as from the other sectors, then the chances are that banks will have no choice but to increase the deposit rates to mobilize the additional funds. And if their deposit rate goes up, then certainly their lending rate would go up. There is no way out for them. So this is, I think, broadly the situation which is emerging. But how quickly the situation will move towards, say, housing lending rate, almost matching the government's, borrowing cost, etc., would again depend upon, the way the CASA of the banks moves over a period of time.
Okay. Mr. Subhash Chandra Garg, now in a way, this is more misery for the people of this country, which, who already are facing a lot of problem thanks to rise in inflation level that we are witnessing, because everything that you see around is expensive. Is there anything, because you understand the government and the process very well, is there anything that can be done by the government, or do you think this is something that the people of this country will have to be now prepared for? More EMIs every month.
See, the inflation affects everyone, but it affects everyone differently. It doesn't affect everyone in the same manner. For example, the government servants do get the DA, the dearness allowances linked to the consumer price indexes. So they, in a way, are in a better position to face the higher cost of services and the goods they buy. But there is a very large constituency in the informal sectors, the people who live on wages. They don't have their wages indexed to the price rise or inflation. They suffer the most. Cost goes up for them, but their incomes don't go up in a matching way. Economists normally tend to see higher wages as a contributory factors for the inflation, but we should see the higher wages or compensating for the inflation as something which is equivalent to face the higher cost of goods and services which they buy. So it affects differently the bond holders, it affects differently the fixed deposit holders. There was a discussion here that the higher interest rate for the depositors is a good thing, but many of the depositors are already locked in. Most of the deposits in the fixed side are locked in for the rates of interest. They don't get higher rates of interest, but the new deposits can come at a higher rate. So the different set of people get affected by differently. So for the government, the real and good option is to keep the inflation low. And that is what government working with the monetary authority try to follow policies to make the inflation low. And that is where the tools which are available for keeping the inflation low is to raise the interest rate, to curtail the demand, to bring down but we have a very different situation today. The inflation what we are seeing is not because of the higher demand in India. Unfortunately, demand still is less than pre-COVID level for the consumption side. But this is supply shocks, imported inflation, and many other things. So government and the RBI is very faced with a very difficult situation. Government can do something to provide some relief, let us say for the house owners, by increasing what is deductible in taxes, or providing a little more subsidy for the EMI for the affordable housing scheme, like the government is trying to do for managing the higher cost of fertilizers and the higher cost of some other commodities. But very, very difficult choice. The short-term pain, which might actually extend to the medium term, will perhaps have to be borne, and borne with a straight face. There is no easy options available. So I think we should all work to see that the inflation genie is put back into the bottle as soon as possible, and face the temporary misery or the pain. I think no easy options.
No easy options, but what are the solutions, Dr. Brinda Jagirdar? How do we put that inflation genie back into the bottle? That's $1 million question. Any recommendation?
Continue growth and continue reforms, because when the economy grows, that's when you're helping increasing the supplies, and that you're helping to keep inflation down. So we have a cost push factor which is pushing up inflation. We have an imported factor which is pushing up inflation. Demand is still weak, but still it is picking up. So if the Reserve Bank increases the rates too much, is going to, hurt demand, which will again in turn hurt the economy. So I think the only thing is to keep pushing on reforms, to pushing on growth, and make sure that the economy continues to grow. Because of these conditions, growth, the numbers have been cut down, but still India is one of the fastest growing economies in the world, and I think we should build on this. We should build on our manufacturing. We should build on this tempo and this momentum which has been created in the economy, and that's the only way to go forward.
Okay. Mr. Garg, any, band-aid kind of a solution that you can offer that the government could use immediately so that the immediate pain that people are already facing, that expected to intensify in the days to come, could become slightly less?
So the government actually has been doing lots of band-aid kind of solutions. So food subsidy, for example, giving the free food, extending that schemes beyond the 31st March to 22 for another 6 months, which may again likely be increased for another 6 months going forward. Another band-aid is not passing on the fertilizer costs to the farmers, and in turn, as the cost of production of in the form of the MSP and all. So I think the band-aid solutions have been tried quite a lot. The government has actually been also in fact, it was an unconventional, more difficult kind of decision. During the COVID, the government of India did not go for a free distribution of subsidy or aid or grants for the people like what happened in US and elsewhere. And that kept the inflation a little lower. In fact, many people, including me, have been critical of that, because that time when the people who went out of their jobs needed support from the government was not provided. But that was done for keeping the inflation low. But today, those band-aids and those solutions don't work. And they are not able to control the inflation. So I don't think there are easy options. There are more band-aids available for handling the situation. I think this has to be faced. And if the government can utilize this, what was being talked about by the ex-economist, chief economist of the SBI, that if you can expedite the reform agenda, because that will bring the productivity into the economy, and that will raise the or decrease the cost of production in times to come. The public sector banks, insurance companies, BPCL and other companies complete that privatization agenda and all, so that the productivity of the economy increases, the growth in the economy increases, the supply becomes more available. So I think, but those are not short-term, those are not band-aid solutions. Those are difficult, but eminently doable kind of thing, and must be done.
They are difficult, doable, and required at this point in time, given the current circumstances. Thank you very much, all of you, for joining us here on Urban Debate on Mirror Now this evening. Of course, we'll be tracking the story very, very closely ahead as well. But thank you for this wonderful discussion on this very, very important subject, Mehengai, misery that's impacting each one of us because of especially what's happening between Russia and Ukraine.